And if you have a good understanding of what money is and how the financial system works, you wouldn't realize that QE is not actually super hyperinflationary. I remember when the Fed first did QE back in 2008, 2009, you had so many people who were crying about hyperinflation. And in fact, I think a lot of people in the market bought it as well. Back then, gold prices continued to soar because everyone was saying that the Fed was printing money and that would lead to imminent inflation. That didn't happen. In fact, if you look across the world, you have the Bank of Japan also doing tremendous amounts of quantitative easing. You had the ECB do that as well, and the Swiss National Bank. And in all those countries, over the past 10 years after the great financial crisis, you really couldn't see inflation everywhere. So when the facts, don't support your theory, you have to figure out what went wrong. And the problem, I think what those people misunderstood was, yes, actually the Fed is printing a lot of money, but you have to take the next step and think, what are they doing with that money? So what the Fed and other central banks were doing, where they were printing a whole lot of money and then using it to buy treasury securities. So this matters because in the global financial system, treasury securities and other sovereign bonds are basically a form of money. For example, in the US, if I have a $100 bill, or let's say in the UK, you have a £100 note, in currency, you can use that and you can buy stuff, right? In the same way, let's say $100 in US Treasuries, it's also an IOU issued by the government. It also has no credit risk, and you can easily sell that to get currency to buy stuff. And so in the modern financial system, in the modern fiat-based financial system, sovereign debt is a form of money. $100 in treasuries is like $100 that pays interest. Another way you can think about this, let's say that I am an individual investor. In my trading account, I have $100,000 worth of treasuries. Okay, and the next day, mysteriously, that $100,000 of treasuries is replaced with $100,000 in deposits. Does that really change the amount of purchasing power I have, the amount of wealth I have, what I can buy? It does not. And so what the Fed was doing and the other central banks in the world were doing is that they were printing a lot of money and using it to buy what was basically also a form of money. It's like printing a lot of $20 bills to buy $100 bills. So obviously the amount of purchasing power that the private sector had did not change with that. What did change is that it made interest rates go lower and interest rate sensitive assets go higher in value, which was exactly what the Fed intended. So you can see very clearly over the past 10 years of QE, of central bank money printing, so to speak, you had financial assets inflate, but no obvious change in, I think, the price of goods and services, so the CPI inflation. And the reason is because the private sector didn't really get all that free money from the central banks. The central banks really just changed the profile of money in the system, lowering interest rates in the process.
And is that something that I guess we knew before we started QE? Because obviously, we could say 2008, Ben Bernanke, he was the one. Oh, yeah, sorry.
Yeah, no, you're exactly right. It was something that some people understood. Bernanke obviously understood that. That's why he did it, right? He did not want to cause hyperinflation. That's no one's intention. But what you notice as someone who follows the market a lot is that in the market, there are many different points of view, and some of them are complete nonsense, and some of them are pretty good. It's not always the ones that are good that win out this debate in public opinion. One easy way to see this is not just in 2008, when the central banks and Bernanke were correct and all the people who bought gold on hope of hyperinflation were wrong, but just more recently, the past few months. If you understood what was happening in the financial system and the impact of fiscal policy, you could have suggested that inflation would not just be not transitory, but it would have been high as it was in 2022, and it would have been persistent. And in my work over the past 2 years, I've consistently highlighted this. But if you look at the markets were first in denial of high inflation and then completely bought into inflation as transitory. And so the people who are holding those views probably lost a lot of money. So the market is always a struggle between different frameworks and different points of view. In the long run, I think that the ones that are correct do win, but the long run is a long time.
Are these banks loan more, or is there any other ways?
So yeah, the Fed. So you make a really good point. So in the monetary system, most of the money is created by commercial banks when they make loans. The Fed can influence this through two ways. One, as we are most familiar with, interest rate policy, right? So in theory, you could juggle interest rate policy and create more demand for loans. So if mortgage rates are 3% in the US, more people want to take out mortgages, and so that creates more demand for some stuff. Another way that's less obvious, but also very important, is through regulation. So when a commercial bank makes a loan, it has to comply with certain regulations. It has to hold capital. What capital is, it's basically, it's like money to absorb potential losses so the bank won't go bust. The Fed can toggle that to make it less costly for banks to make loans, or it could raise the cost of banks to make loans, so as to decrease the supply of credit creation into the economy. So that's another way. That can also be used politically. For example, more recently, there's some discussion that the Fed will try to impose more climate-related regulation on banks, which could be used to discourage loans to the fossil fuel industry and encourage loans to industries that are more that they think are better, so to speak. So there are basically two tools the Fed can use. Right now, it's leaning heavily on interest rate policy, trying to raise the price of interest and thus decrease the demand for credit. And it's working really well in some segments of the economy, like the housing economy. So in the US, when people buy homes, they take out 30-year mortgages. A year or two ago, 30-year mortgages were less than 3%. So huge surge in home prices, 20% year over year. Now mortgages are probably 6%, 6.5%, and that's definitely reducing demand for homes. But that's just one segment of the economy. The way that monetary policy works is that it influences different segments of the economy unevenly. It's like swapping money for money. But here's where you can have something. Here's where it's a little bit different on the upside than it is on the downside. So when the Fed does QE, it does it when the interest rates are very low, right? So you're taking like $100,000. Okay, so you're buying a treasury security that's maybe yielding, let's say 2-3%, and you're paying for it with deposits, a bank deposit, that yields about 0%. So from the perspective of the investor, that's not that big of a difference. Instead of getting 2 or 3%, I get 0%. Okay, but right now the level of interest rates is a lot higher. So when you're doing QT and you're reversing that whole process, then someone that had a bank deposit that was paying close to 0 is suddenly going to get something that yields maybe 4% now. So if you are an investor and you had 0% bank deposits, maybe what you would do, so 0% in your checking account, maybe what you would do is you would speculate in the market. You could buy AMC or Tesla or something like that, because over the past few years, okay, it didn't work very well last year, but over the past few years, it's kind of worked pretty well.